Welcome to the Market Meter podcast. My name is Raikad. I'm one of the co-creators of the podcast. Today's topic is sacrifices that one needs to take to get on board investments. I am joined by Abraham Wakiaga and Anthony Sure. As I begin, the topic will revolve around what really takes to become a successful investor and to maneuver the cycles in the market. We'll break it down to you in terms of time, savings, support, research documents, and the strategies that one can start to pick up early in life. So I'd love to begin with Anthony Sure. Anthony?
First of all, I think you have to first of all define what your motivation is going into investment, because investment in itself is not an end. You have to have a goal. What are you looking for? What is your main reason for getting into investment? Because once you have your reason, everything else falls in place in the sense that you have that intrinsic motivation to keep going. Because if your only reason for maybe investing in a company is because everyone around you is investing, those people's expectations or goals have been met, and then they pull out of the investment, and then you're caught wondering, okay, do I stay here? Do I remove my money and wait for the next big thing to come along? So you have to define why you're investing. You have to take the example of maybe just a person who started working recently and they have some money lying around. Then you come to realize that, hey, if I leave it in the bank, inflation is going to be eating away at my money. Last month's inflation came in at around 6.7%, and maybe you have your money in a bank account. So even if you're earning that 3 or 4%, inflation is eating away 2 to 3% of your money. So the first sacrifice you make is investing in gaining knowledge as an investor, because you can't invest in something you don't know. I'll give my commentary on this going forward, but Abraham, I'd like to know what's your go-to when you want to get knowledge on investment?
Yeah, so I'll just pick up from where you stopped, and interestedly, I'm just gonna give a cliche response. I googled it. That was the first thing I ever did. I was trying to figure out what investment is about, because I remember even like in the previous episode when we were discussing about where we began from. One of the curious things I was just trying to go about, or rather trying to satisfy, was how do people manage to just make this money almost out of like thin air? You just put money into a certain stock and cash is just coming out of nowhere. So I googled first of all, and then from there, of course, you get more familiarity with some of the notable investors. Again, let me just use a cliche person for the purposes of this podcast. Guys like Buffett and the likes, Warren Buffett, who you hear their stories. They invested in a certain company when it was at inception, and how it probably grew to a multinational, and they've managed to gain from such investment. So that was the starting point. Like that's me being extremely green about it. But with time now, I got into books. I remember trying to understand the same. I didn't get into academic books actually. There's a certain book, I've forgotten the title, a very good book that really tries to break down the issues related to investment, especially on the stock market, bonds, how to save up, starting a business, etc., etc. So I went into books. Then thereafter, as I grew further, I think it came down to now much more analytical points of view. And with that, now I started even getting into things like, following the Financial Times, reading Bloomberg, watching financial reports, reading financial reports to try and just have a feeling of what's going on in the market, what's going on in the economy, because you need verifiable facts in order to advance. So in a sense, there's been that sort of progress, and I think I'm still in that process, because I don't even consider myself a successful investor. But nonetheless, when I look back, there's been that step-by-step process from one point of growth to the next. So yeah.
I agree with you, Abraham. Because when you're starting off, actually the first thing to do is you have to Google it.
Yeah.
Because try to understand, try to get curious on how do these people make all this money? How do people become billionaires? The likes of it. Most of them have one thing in common: either they started a well-off business or they invested in the stock market. So I'd also add on to that in terms of time, one really needs to sacrifice the time. I remember when I was trying to read on stock market, I had downloaded some videos online from torrents. Then as I was watching them, got boring for me at first. Then I switched and started watching Game of Thrones. So then I realized, so if you go further beyond our country, you find that companies even make more than 100% in terms of their share price changes. So you find that people are making more than 100% their money in a single year, while you are here making around 7% or 5%. So again, that brings the aspect of savings, because now where do you save your money? Should you put it into bonds? Should you put it into like venture capitalists, or should you put it into a normal, like, how can I put it? In Kenya, we
Yeah.
call it a retirement account.
Pension.
Yeah, or a pension fund. But you then figure out that if you put it in a pension fund, you find that you're paying for some diversified portfolio that it's not gaining as much interest as could have done it alone, because they try to split you into terms of gauging you. Are you at a high risk? You are low risk type of investor? Are you medium? So if you look at the pension fund, they have tight regulations in terms of most of it should be invested in the local market. So you find that they can only buy a few foreign equities or currencies, but you will find them heavily weighted towards the bond market and the stock market local, where your opportunities are how can I put it, are enclosed in a box, whereby if you diversify your portfolio in that you have a wider scope of where you can invest your money, you're no longer in a box, where you can invest in big tech stocks like Apple, you can invest in other industries that you deem your knowledge towards it. And also in terms of deep analytics, this industry does not need a lot of analytical skills. To borrow a phrase that I had somewhere, a man with a hammer, to him everything looks like a nail. He just wants to hit everything. So you find some people have done all this these crazy analytical courses and a lot of coding. So to them, since they have those skills, that is their hammer. And when they come to the market, they want to use it. So everything to them just looks like a nail. They just want to go deep into those analytics. But if only just to understand the business, understand how much its revenues are going to grow, how much the debt is, because the company cannot go broke. That's not debt. It's very hard.
Mm.
And also sacrificing in terms of research and buying the books that are necessary for you to read. Like if I could give a cliche of a book, The Intelligent Investor, it is widely known like a Bible to most investors. But if you go into the industry further, you can find people like Templeton, Ray Dalio, and many more others who are also finding workable strategies. That is, if you have identified key people who are making money in the industry, you can try to like understand what strategies they use, what's the investment philosophy. You will find others are global macro, like most of me, Tony and Tony do a global macro, value, contrarian at the same time. Those are types of investment strategies, whereby global macro you can find it's in that now you have what's going on to the economy, and also how is it affecting the company in terms of its intrinsic value. Also sacrificing in terms of my time to study a lot. So if you're planning on getting on board, there's so much sacrifices you need to make in order to achieve your dreams and your goals and your targets for your investment culture. What's your take on that, Tony?
So first of all, let's just take stock of whatever you've said, because we've talked about a lot of things. First of all, we have talked about investing in knowledge. You start off, as Abraham had said, Googling it, because that's the first step you make. There's something called opportunity cost. You can get to spend your paycheck in a day, but your money, your resources are limited, but your wants are not. Squeeze yourself as much as you can and invest as much as you can, because it's not friends, whatever, you and your race. And as Raikard has said, you, in terms of sacrificing your time also, there are a lot of things people do that are not, that might be fun, but they're not, how can I say, they're not vital. They're wants, not needs. Investment, I consider it to be a need for any sane person. And at some point, I'm not saying you base your life around learning about investment and doing all that. That might not be your thing. You might like going out with your friends and drinking. Everyone does that. But as long as there's a level of moderation and you allocate enough time to yourself to sit down and try to make sense of your finances and try to understand how best to invest your money. Because as I mentioned in the first podcast, those people are celebrating now that like today equity was trading at around 53 shillings. Those people are celebrating now that bought during the IPO. They had to make a
Yeah.
sacrifice at that point. Yeah, it didn't mean that they didn't have that money, could not have been used for something else. It's just that they made an active choice. Like, I could have used all this money in other places, but I choose to put it in this company that might have a future in this country. And that's literally the true a reflection of what happens when you make the appropriate sacrifices and your discipline in terms of your investment and your dedication to your growth in your personal finances. I think now, Abraham, I don't know if you have anything to add on there.
Yeah. Actually, just as you're speaking, I'm actually gonna just sound like a typical millennial critic, but I'm sure you guys have heard of this whole aspect of delayed gratification, and our generation generally has been accused of really wanting quick money. It's probably why guys truly believe in investing in crypto, for example. With that volatility, they think they'll just get quick cash, for example. Although that's a discussion for another day, but based on that alone, we can really pick out these elements of having to learn the skill of delayed gratification. And that means sacrificing a lot. I mean, it's just summing up what you guys have talked about, sacrificing money that probably you would have used to, again, Netflix subscription is a touchy topic. I don't think I'm going to sacrifice my Netflix subscription, but if need be, if need be, I'll have to do it, and probably buy, those shares. Hopefully, let's say Family Bank decides to IPO. Yeah, Family Bank is not on the NSE yet, is it?
No, it's not.
Yeah. So let's say they decide to IPO, and you're confident about it, and just say I'm not watching Netflix for the next 12 months. I'm gonna just buy shares slowly, in the hope that eventually this is gonna be, profitable in the long run. So yeah, just that whole element of delayed gratification. It's important to develop that skill, especially. I'm just targeting our generation, the millennials and the Gen Z guys. That we need to be able to realize that this wealth doesn't come overnight. It doesn't come in a month. It takes a lot of time. And the reason why I started with Warren Buffett is, I think, is like the best example, or rather the most popular example of someone who invested in something of value over a very prolonged period of time, and we can all pick something from his personal journey.
I agree. The other point on delayed gratification, I think it sums up everything.
So we've talked a lot the sacrifices that are necessary for you to put yourself in the best possible position to benefit from your investments in future, because that's mainly what it's about. It's about the future. It's not about now. On a long enough time frame, it's your own race. You might have had people around you, and you're making certain decisions, but in the long term, you want to put yourself in the best possible position. So as far as the investment is concerned, we'll be having whatever asset classes you're interested in, and we'll also be actually publishing a blog. We'll have a market commentary this week. You should check on our social media. We'll share links to our weekly market commentary, but on our blog we'll also be updating on different ways you can actually get started investing in all this, with links and step-by-step guides so that you can give you the best possible information you need. So Reka talked about investment philosophy. Dividends are a share of profits that companies distribute to shareholders. In the US, it's quarterly, but here you might find semi-annually or annually. So a percentage of the profits they make, they distribute them to their shareholders. The distributions are called dividends. So those are what dividends are. Growth investing is investing in companies that don't necessarily they're not necessarily paying dividends. A growth company is a company like in Kenya, we're speaking in the sense of the NSC, something like equity. Equity is set up now in DRC. They have a branch in Ethiopia. They've been reinvesting a lot of their income, growing regionally. But for the past 2 years, I think since 2019 or 2020, they have not paid dividends. But as I said earlier during the podcast, equity has been hitting all-time highs within the past few weeks. People have been buying the stock. That's what we call a growth stock. A growth stock, most of the money they're making, they're reinvesting. So that's growth investing. Investing in companies that are maybe market leaders or companies that have unique technologies or they're really growth oriented that don't necessarily share profits, but the stock price is rallying a lot. People are very confident about the company. Value investing is looking for companies that are undervalued and you buy them, or in other markets where there's short selling, you find a company that you think is overvalued and you decide to short sell it. But that's short selling is not very common in the local markets. So you can look and say, hey, this is not its true value. I think it should be trading way higher than it is now. And how you arrive at this, there are different valuation methods, but the most widely used is the PE ratio, price to earnings ratio. So you compare the price of a stock, you divide by the earnings per share of the stocks. The lower the PE ratio, the more undervalued a company is. The higher the PE ratio, the more overvalued the company is. So that's a basic value investing strategy. So that's value investing. And thirdly, income investing or dividend investing. This is investing in companies that are known to historically pay dividends on a periodic basis. Like if you look at Williamson's Tea or Capchoria Tea, or even Safaricom, consistently since they IPO'd in 2008, they've never missed a single year to pay a dividend. Even during COVID, they paid, I think the full year dividend was around one shilling and 54 cents or 34 cents. I don't remember exactly, but income investing is you're not necessarily investing because the stock price is going to rise. You're investing because that company has a history of sharing their profits on a yearly basis, paying dividends on a yearly basis. So those are the main investment philosophies. You can read up on them. So as I've said, growth investing, value investing, and dividend or income investing. There are other philosophies, but they require more in-depth understanding, such as global macro, as Rikard has said, or even quantitative investing. It's actually a school of thought, but I wouldn't advise it for a retail investor, because you're competing with guys with supercomputers and you're there with your PC. That's a whole other thing. I don't know if Rikard has any additional ones.
Yeah, I could touch a bit on the global macro and also a bit on the value investing as you've said it, and try to outlay to the shorts, quants, and cigarette butts. So for global macro, actually what it entails is a combination of both top down and bottom up, whereby top down come from a point of understanding what happens from the global economy. So you look at it from a world view, then you go to the industry view, then you go to stock selection, then having discipline type of criteria. Whereby in the world view, you try to understand what the global interest rates are doing for the major economies, the inflation impacts on equities, on commodities, and all that. Then you see how it affects it on the industry. Then you find the stocks which will be affected. So you try to list the positive ones and the negative ones that can be affected. Also, in the bottom up, you try to find companies that are undervalued, as Tony has mentioned. So bottom up is more or less like invest. So you try to find companies that are undervalued given the historical valuations. Like he gave an example of the price to earnings ratio, But there are other multiples that can be used, like price to cash flow, price to sales, price to book value, EBITDA, and having a long-term view, primarily 5 to 10 years, because stock price does not determine what the company is. So whatever you see at the business news, like in television, that does not determine the value of the company. In terms of also shorting, what it means is that you make money from a company falling the value. So you can try it by doing this. If you think, let me give us an example of Safaricom. If Safaricom has gone up in share price like for the past like 6 months, and you have your shares there, and then you reach a point you feel like this company is too overextended. If you look at it, it's way beyond its historical levels. You feel like it should reach a point where this share price will have to go down. You don't want to lose in terms of the volatility of it going down. So what you can do, you can go to the derivatives and you put a short order. In that now you are counter trading what you had put. That's called hedging. It's a type of a strategy called hedging, where you are long and short at the same time. So if you're indeed correct that it goes down in value, you'll make money from your shorts, but you'll still have your underlying securities. So when the market picks up again from its correction, you still have your original value plus top up of what you have gotten from your short. So I think we'll talk about it in depth in the podcast in terms of each and every individual strategy. And to touch a bit on the quantum trading, my first job I worked at a fund. It's called Quantum Financials Consultancy and Corporation. It's based in Karen, in Nairobi. So I was there at a quant fund. I was a financial analyst. So I can pretty much say that you can't be able to beat the quants in terms of short-term opportunities. So you need to broaden your scape to 3 to 6 months. That if you want to be a swing trader or just basically going to value investing. So I think we'll talk more deeply per episode in terms of the strategies so that you as our listeners can be able to understand each and every strategy.
Feel free to follow us on our Twitter page or on YouTube at the Market Meter Podcast, and just also feel free to interact with us. Any questions that you may have or any comments. Thanks for listening.